Welcome to Richard Suttmeyer's 4 in 4. 4 blips on my radar screen presented in 4 minutes or less. Today is Tech Tuesday, so I will begin there and then expand my thoughts to energy and financials, which have been influencing market volatility over the past few weeks. My first blip looks at the weekly charts for the NASDAQ and the Philadelphia Semiconductor Index, the SOX. The weekly chart profile for the NASDAQ stays negative, with a weekly close below the 5-week modified moving average at 2320. Weekly support is 2165. The SOX has a negative weekly chart profile after setting a new 52-week low at 330.24 last week. My new monthly support at 320.81 should prevent a major breakdown, but the upside should be limited. My second blip looks at the daily charts for Apple, Google, and Cisco, who reports after the close today. Apple's weekly chart is clearly negative, below the 5-week modified moving average at 164.32. My monthly value levels are 140 and 137.44. Google's weekly chart is also negative, with the 200-week simple moving average as support at 414.58 and the 5-week modified moving average as resistant at 502.53. Cisco's weekly chart is also negative, with my monthly value level at 20.79 and semi-annual pivots at 2116 and 2159 and the 200-week simple moving average at 2283. Cisco reports quarterly results after the close today, and the stock is ready to buy according to automated stock alerts, and has been in Richard Suttmeyer's sector report model portfolio since July 14th at that 2116 level. My third blip looks at the topping out pattern for NYMEX crude oil just as pension fund increase commodity investments. The weekly chart for NYMEX crude oil shows that the parabolic bubble is popped. The weekly close is below the 5-week modified moving average at 128.81, indicates risk to my annual supports at 78.40 to 76.30. According to sources, pension funds have increased allocation to the asset class called commodities to $300 billion at the end of the first half of 2008. This demand is called speculative by the CFTC, which in my judgment is wrong. There should be a separate category called investments. The CFTC should also increase margin requirements. Pension funds are not even aware that their investments in commodities are not diversified. 78% energy, 41% NYMEX crude oil is not a prudent allocation for retirement money. Standard & Poor's should reduce allocations to energy. The CFTC should set a third category called investments, and they should raise margin requirements. If commodity investments were properly regulated, consumers would not have been choked on $4 gasoline. My fourth blip looks at the financials, my other cause for concern. The regional banking index, BKX, held up well, but I see more bad loans rising. I don't see an end to this in sight. My main concern is construction and development loans. WCI Communities is the first publicly traded home builder to file for Chapter 11 bankruptcy. We are seeing more bank closures by the FDIC. Home builders owe community banks, which keeps the pressure on. If you have any comments or questions, shoot me an email, gmcreports@aol.com. That's today's 4 in 4. Enjoy your day.